Hi everyone, welcome to the channel. My name is Philip and I am the founder of Kwajami Financial, an independent firm that provides both financial planning and investment management services to Ontario residents. If you are a returning subscriber, welcome back. If you are new to the channel and would like to learn more about financial planning and investment, please click the subscribe button and the notification bell so you don't miss any upcoming videos. Don't hesitate to also click the like button if you enjoy this video. It will make a huge difference in helping the channel succeed. Today's video will be a bit different from previous videos, as I thought it would be helpful to define 10 investment terms every investor should know. Hopefully those terms will have no more secret for you by the end of the video. So let's get started. Here are the 10 investment terms I would like to discuss today. Number 1, asset class. An asset class is a grouping of investments that share similar characteristics. There are two main approaches when it comes to investing. The first approach is to lend some funds to someone and ask to be repaid the full amount plus interest, according to an agreed upon repayment schedule. This form of investing is referred to as loanership and corresponds to buying a bond. The second approach to investing is to buy outright an asset with the expectation that the price of the purchased asset appreciates over time so that we can make a profit when we finally decide to sell the asset. This second form of investing is referred to as ownership and corresponds to buying a stock. On the side note, I would like to acknowledge a former colleague of mine who shared this definition with me early on in my career. Number 2, asset allocation. You can think of asset allocation as an investment strategy that essentially aims to balance risk and reward by assigning a target weight to each asset class you want represented in your portfolio. Your portfolio asset allocation is determined by your personal circumstances, including your objectives, risk tolerance, and investment horizon. And so, let's say that after careful analysis, you decide to hold 30% of your portfolio in bonds and 70% in stock. This breakdown between bonds and stocks would then represent your asset allocation. Asset allocation is an important concept as it is known to be one of the biggest drivers of your portfolio's performance. Number 3, asset location. Asset location is essentially a tax minimization strategy which recognizes that investment income such as interest, dividend, and capital gains often receive different tax treatments. And so to maximize your after-tax return, you may need to determine which securities to hold in your tax-deferred account, such as your RSP, and which securities to hold in your tax-exempt account, such as your TFSA. Number 4, active investing. An active money manager promises to deliver above-market returns on a risk-adjusted basis. Essentially, active management consists in selecting an index benchmark and building a portfolio of carefully chosen stocks that will outperform the benchmark by consistently delivering superior performance for an equivalent level of risk. At least that's the expectation. Active management requires to conduct an in-depth analysis of individual stocks to formulate, let's say, a 12-month price target. And undervalued stock, i.e., a stock whose current price is lower than the price target, would be purchased, or an existing position would perhaps be increased. Similarly, an overvalued stock, i.e., a stock whose current price is higher than the price target, would be sold, or an existing position would perhaps be reduced. Quite tricky to do in practice. Number 5, passive investing. Passive investing is also known as index investing. Unlike the active investor, a passive investor will accept to receive overall market returns in exchange of a much lower investment cost. In practice, a passive investor will purchase an entire market by purchasing an index fund or an exchange-traded fund whose objective is to replicate as closely as possible the return of a specified benchmark index, such as the S&P 500 index or the TSX CAC Composite Index, just to name those two. Number 6, market risk. Market risk or systematic risk is the risk of experiencing a financial loss due to factors influencing overall market prices. This is the risk an investor would take simply by investing in financial markets. Some examples include currency risk and interest rate risk. These risks cannot be eliminated through diversification, although investors can attempt to hedge against them. Number 7, specific risk. Specific risk or unsystematic risk represents the risk associated with a particular company or industry. Unlike market risk, specific risk can be diversified away. For instance, let's assume that you hold 500 stocks in your portfolio. If one of the firms you invested in were to go bankrupt and the stock lose all its value, the impact on your portfolio would be very minimum, if even noticeable, because of your portfolio's limited exposure to that particular stock. Number 8, portfolio rebalancing. Rebalancing a portfolio consists in bringing the portfolio back to its intended target weights as specified in the asset allocation. For instance, it is not unusual to see a higher exposure to equity after a great bull market. Bringing the equity exposure back to its intended target weight would perhaps be needed to maintain an appropriate portfolio risk level. This process is called rebalancing and is fundamental in portfolio management. Number 9, time-weighted versus money-weighted return. There are two commonly used methods for calculating the return of an investment portfolio. The main difference is that the time-weighted return eliminates the effects of money cash flows, i.e., deposits and withdrawals to and from the portfolio, while the money-weighted return includes these effects. Depending on the market movements over the analysis period and the timing and magnitude of the cash flows that affected the portfolio, the time-weighted return and the money-weighted return can be significantly different, making comparisons among investors that much more difficult. So beware. The next time you review your statements, know which one of the two types of return you are looking at. Number 10, volatility. The value of an investment is likely to change over time. Occasionally, the change in value can be both sudden and profound. The stock market would be an excellent example of that. Stock prices tend to constantly move up and down, and the amplitude of these fluctuations is commonly referred to as volatility. Essentially, the more rapidly the price of a stock varies over a specific period, and the larger the magnitude of these variations, the more volatile the stock is. A higher volatility generally indicates a riskier investment, which translates into a greater potential for gains or losses. Investors cannot unfortunately avoid market volatility, but a well-developed financial plan combined with a well-diversified investment portfolio will surely help you navigate periods of increased market volatility with greater peace of mind. Understanding those 10 investment terms, I am sure, will put you further ahead. I hope you have found this video informative. As always, don't forget to like and subscribe. Thanks for watching and see you in the next video.